Hello everyone, welcome back to Property Couple. I'm Leah.
And I'm AK.
And this is our channel where we talk about property investing, business and working together as a couple. So we have a very special guest today, don't we?
Yeah, Mr. Sam Norris, the property investor's broker.
Hey!
The one and only.
Yeah, the one and only Sam Norris.
Yeah, although there are a few other Sam Norrises. Apparently there's a really good dirt bike rider called Sam Norris as well. So
Nice.
I compete with him for online
Nice.
space. Yeah.
Which is why your handle on social is
Yeah, the
Sam Norris.
Yeah, so they don't get me confused with that guy.
Okay.
Yeah.
Thank you so much for coming onto our channel. We've got loads of questions here, which you probably get all the time. And we wanted to throw these questions your way because obviously we're not brokers. You're the property investor's broker. You're the guy for it. So,
Yeah.
Hopefully.
yeah.
Let's see. We'll find out in a minute,
We
right?
will find
We will find out, yeah.
And there's one question that we get a lot of people ask us, and that is, am I allowed to rent out my house on my current residential mortgage?
Yeah. I get this a lot as well. Yes, you can, but you have to ask permission to do so. It's called
Right.
consent to let. So what will happen is you pick up the phone to Santander Nationwide, whoever your mortgage lender is, and say, I'd like to rent a property out, can I get consent to let? They will do one of a few things. Sometimes they will say no. If you haven't owned the property, usually for 6 months, or haven't had a mortgage with them for at least 6 months, sometimes they might say no. They may charge you a little admin fee to do it, but yeah, you can. And you don't also, this is another misconception, people get concerned, oh, I've got consent to let, now I have to leave my house and I have to rent it out now. You don't. It just means that as and when you want to, you can start doing that.
I see, that makes
What
sense.
happens if you don't get consent to let, but then you let your house out?
You are theoretically in breach of your mortgage contract,
Yeah.
which is actually fraudulent activity. Don't want to get people too upset.
It's like mortgage fraud, basically.
It is mortgage fraud, yeah. I think there's a lot of stuff when it comes to mortgages and the F word comes up. It's very scary, but it's true. You know, if you're in breach of any contract, it's fraudulent activity. A mortgage is a financial contract between yourself and the lender, and if you break that, you're in breach, and they have every right to actually ask you for their money back. So it doesn't happen too often.
Yeah, for sure. Because one thing that I don't know if is true or not is that when you're asking a lender for consent to let, do you usually have to have a special reason for it? As in, look, I'm in financial difficulty, but it would really help me if I could let out my property, get some income from it, and therefore pay you your mortgage.
They will probably ask you. Generally, the reasons that I see are, I want to buy a new home and I don't want to lose my existing one, or I'm moving abroad with work, or financial difficulties. You know, we're moving out and we're just gonna rent the property instead. They probably will ask. There isn't really a right or a wrong answer. As long as you give them some particular reason, they're not going to be too concerned over it. In all honesty.
Yeah. Okay. Well, I'm so glad you answered that because we get asked it quite a lot,
All the
don't
time.
we?
Yeah.
So here's a question that actually we would have had, we wished we knew when we started.
Yeah.
So I am a first-time buyer and first-time investor. Is there any product out there for me that will allow me to break into the property investing space, or do I need to buy my own home first?
Cool, yeah, so I get this a lot as well, and it's actually a weird one when you think about it. So say you wanted to go and buy some gold, or you wanted to invest into an index tracker, and you called Hargreaves Lansdown, I want to open an index tracker. Oh, do you own your own home? Can you imagine how that's actually quite ridiculous when you think about it. But yes, on the whole, lenders 90% of the time are much more comfortable if you own your own home first. It shows that you have some financial stability. It shows that you have a history of paying a mortgage, which is useful for them as well for their risk assessment. So on the whole, yes, it is very useful. It's not impossible, however, to be a first-time buyer, first-time landlord. There are a couple of ways in, really, which is number one, if you are buying a property that is ready to rent, turnkey investment as we call them, then there are some mortgage lenders that will be able to help. They will vary in terms of how they go about doing that. For example, there are some relatively well-known high street lenders that will actually do this, but they will assess your affordability for that mortgage in the same way they would as a residential mortgage.
Okay,
so they will check your personal affordability to pay those mortgage payments, and effectively this is to avoid it becoming what we call a backdoor residential. It's easier to get a buy-to-let mortgage from a criteria perspective. Therefore, you struggle with affordability For a residential mortgage, you just buy a buy-to-let and then you just move in, which again,
wow, mortgage fraud. Wow.
So we can do that. If you're buying, there are some specialist lenders as well that maybe if you're buying through a limited company, they can be a little bit more flexible, because as much as they are still, in theory, still lending to you, you are the ultimate beneficiary owner. They see that level of having that limited company, the professionalism, they're going to be a little bit more okay with you being a first-time investor. The other way of doing it is if you're going down the buy, refurbish, refinance route, BRR, or you're doing a conversion or a flip or something like that, you can use bridging finance, and bridging lenders are going to be much more comfortable with you being a first-time buyer, first-time investor. As long as, I think a lot of the time when it comes to that type of finance, lenders are generally looking for experience, assets and income. They want to sort of in that order. So first of all, if you're doing, say, an HMO conversion, have you done an HMO conversion before? No, I haven't. Okay. Do you have assets in the background? No, I haven't. Okay. What's your income looking like? Well, I earn 78 grand a year. And my outgoings aren't very high. Great, okay, that gives us a little bit of comfort. Not all bridging lenders will be happy with that, but there'll be enough out there to get that foothold, like we said. And then of course, 6 months down the line, there will be some lenders that will say, well, you've owned a property for 6 months, we don't see you as a first-time buyer anymore, therefore we're happy. They were happy with that. There won't be loads even at 6 months, but there'll be enough to allow that sort of double transaction to happen. And then we move on, and things are going to be a lot easier when you come to the next property you want to buy.
Yeah, for sure. I think we definitely felt that with our experience. It was just so hard to get the first one, but then once we got the first one, we were able to.
Yeah.
The door, it was like the door was open.
Anything.
It's like walk through it now.
Yeah, it's like anything. You know, if you're expecting the first time you do something to be easy, then where have you been all your life? The first time you tried to walk, it didn't work. The first time you tried to ride a bike, it didn't work. It's the same with property investing.
Yeah.
But in terms of, on the topic of affordability, then, how much can you borrow?
From a residential perspective, it used to be an income multiple. So if you earn, X amount, they would say, right, we will lend you up to, 5 times that amount, something like that. Back in the day, before the credit crunch, it was like 9 times. It was ridiculous. And to be honest with you, you could do something called a self-certification mortgage before the credit crunch.
Wow.
Where it was like 2 pages, you fill it out, and it would say, how much do you earn? 100 grand. Sign on the dotted line, please. Great. No checks.
No way. So you could actually say what you earn, but inflate it.
Yep.
That is amazing.
And that's how these old people have got these massive houses.
It's exactly it. And when I first came into the industry, those kind of things still existed, and the credit crunch happened, and it kind of put a stop to it.
Right.
But it's incredible how. I used to go and work for some pretty big mortgage companies, and they'd be talking about the good old days where they got in at 10, did 7 mortgage applications, made themselves a couple of grand, and then went to the pub in the afternoon.
Wow.
I could never do that now.
There's
not enough time in the day, but that used to be the way that it was.
The good old days.
Wow.
Born in the wrong era, weren't we?
Yeah.
I look back on it now to when I was at university in Colchester, and the market in Colchester is really great now, and especially between then and now. And back then, I could have, as a student, I could have bought houses and got 110% mortgages.
Wow.
Oh my god, they're paying you to buy the house.
Yeah, they're giving me 10% to renovate the house, get it ready to be rented out to students. I could have been a student and been renting out to other students, and then the regulation was so rubbish, I could have probably just lived in it as well.
That's amazing.
But did you know then what you know now?
No, which is so annoying. I'd be a multi-trillionaire.
Wow. So just going back to what it used to be, the kind of 4.85 times your income, what is it now? How much can you borrow? Yeah, so sort of 2015, 16, 17 sort of time, we had something called the Mortgage Market Review. And part of that was we went from an income multiple to something called an affordability assessment. And basically what that is that they will look at your income, they will look at your expenditure, they'll create a surplus out of that, and the lender will need for you to be able to pay your monthly mortgage payment based on the interest rate, actually usually a stress tested interest rate, so maybe the interest rate that you're paying plus 1%, and then they also want to see that you've got a bit of leeway on that as well. Okay.
So that's how the assessment essentially works. For us brokers, it's quite time consuming because every lender is going to be ever slightly different. So they're different in terms of what they actually take as income, what they don't take as income, how they work that income out, how they work out your surplus. So residential mortgages can be quite time consuming to research, but that's basically how it works across the board.
And then for investment properties, is it a little bit more looking at the deal and what it could rent for?
Absolutely, and this is why I talk to agents all the time, and they say, "Oh, we need a decision in principle before we can get this offer accepted." I'm like, "No, you don't actually. Can you just go to your vendor and ask them, if we put this offer down, will it be accepted subject to proof of funds? Because then I can go and get the decision in principle on the mortgage."
Yeah, for sure.
Because the mortgage is based on or how much you can borrow is based on the rental income. Lenders will use a rental calculator, again usually a stress tested interest rate. So the standard about now is that a lender will take whatever the rate you're paying, they will add 2% onto that.
Okay.
They'll work out what your monthly interest only payment would be at that rate, and your rent would need to be 125% of that figure.
Okay, that's interesting. Okay.
So that's there are variations of that, and there are certain things that we can do if that isn't quite working, because obviously with rates being higher than they were not so long ago, we are seeing that it's more difficult to get to that 75%, which is the standard. So with a 5-year fixed rate, for example, usually they'll do it at the actual pay rate rather than with the stress tested rate. So that gives us a little bit more leeway. And some lenders also offer something called top slicing, which basically means that they can use a surplus in your personal income to top up the mortgage that you can get. The annoying thing with that is that most lenders will not confirm whether or not you can do it until you actually do the decision in principle.
So you don't know. And
I just say to them, can you not just add that into your calculator? Because there is actually a calculator for it.
Right.
Yeah.
But what they say is, when it comes back and says yes, that doesn't mean yes.
Amazing.
It means you've got to do a decision in principle, and then we'll tell you.
Gosh.
So annoying.
Working with riddles.
I'm learning a lot.
Yes.
I'm learning so much. And another question we get a lot of the time is, if I have poor credit history, can I still get a mortgage?
It depends on how poor it is, in all honesty. We're doing a bridge for a client at the moment that's doing an HMO conversion, and the client had a missed payment in November on the mobile phone bill.
Oh,
And
the worst.
the underwriters come back and said, can you just confirm that you are going to be able to refinance this? So I've gone back and said, well, look, by the time we come to repay this, which is probably going to be 6, 7, 8 months, that's going to be over 6 months. And I literally listed out all the lenders that would be comfortable with that particular criteria point. So it is possible. It depends on what it is. If it's just one single missed payment, it's less than 200 quid. A lot of lenders, as long as it was more than 6 months ago, are going to be okay with it.
Yes.
If it was more than just, like, if it rolled on to like 2 months, 3 months, that's obviously gets a bit more severe. If it's a default, a lot of lenders want to see 12 to 36 months clear of it.
Wow.
If it's a CCJ.
One missed payment on like something as small as a phone bill, that's on direct debit.
But you know
on your
what?
account.
This is I guess a slightly different thing to be talking about. But if you want to be a professional property investor, then you have to be professional in all manner of your life, and that means that this is, I see this all the time. The base layer money management isn't there.
Yeah.
I don't miss payments on anything that I have because I don't get the choice to miss it, because I have automation in place to ensure that everything gets paid every single month. And that's because I've learned the hard way of what happens when you do miss those payments. Do you know, I'm a great fan of, right, number one, every single thing that you pay should have its own account. All my bills come out my bills come out of one account. I have an account that I pay for things like petrol in. I have an account that I pay for my like groceries out of, and then I have like a social account that I pay out of. And then I've got all my business accounts.
Business accounts, yeah.
And everythings automated.
Wow.
So I don't get the choice. I check it all the time. But then on top of that, most of those accounts also have savings accounts that run alongside them, or pots. I work to get between 3 and 12 months worth of coverage in those pots to ensure that if something does go wrong with the business, I'm covered for that period of time. So personally, I'm not a liability to my own company. And I think that's what all property investors should be doing as well. Is to ensure that all of their personal expenditure is actually covered with like I guess you call it like a slush fund of coverage. They call it a burn rate in business terms, to make sure that you're covering yourself for that period of time, because then these problems don't occur.
Yes, yeah.
And you can, it's not going to derail your property strategy, basically.
So then how does the debt to income ratio affect the ability to then get lending?
When we talk about debt to income ratio, we're not talking about mortgages, we're talking about personal debt. If you earn 100 grand a year and you had £51,000 outstanding on personal debt, that a lot of lenders would see that as a risk because it goes above 50% of your income you have as outstanding debt. This is why it's always Mercedes. I don't know why it's always Mercedes.
Okay.
But I get clients all the time. I've just bought a new Mercedes.
Okay.
And it's cost me 45 grand, and I've just got finance for the whole bloody thing.
Right.
Great, well done. And then we're looking at their debt to income ratio. It's like, and a lot of them as well are self-employed.
So that doesn't help with
paying themselves 12 grand a year. You know, let's see. You can see the patterns.
You see the patterns. Okay.
And I'm like, okay, this is then causes an issue because as much as you know, then I get a lot of clients will say, yeah, but I'm buying a limited company, so
yeah,
you know, why does it matter what my personal situation is? I'm like, the term limited liability company was founded in like the 1600s. We've just kept the name. You have no limited liability. You are it's there for tax purposes.
All the liability.
You're completely liable.
And just in case you weren't aware, you are going to sign off
a personal guarantee.
Your personal guarantee to sign that liability over as well.
Yeah.
So it's there purely for tax purposes.
Yeah,
that's
for sure.
all that it's there for.
I remember when we first started as well, I didn't know anything about being self-employed or anything like that, and you know, we're signing all these personal guarantees, and I remember saying to Leah, because she's been self-employed most of her life, you know, why I don't understand, like, don't we have everything in a company? And she's like, mate.
I was like, nah, this is all coming crashing down on us if it goes wrong.
Yeah.
We're signing away every right we have.
Yeah, exactly.
It always makes me laugh because people say, oh, I don't really want to sign a personal guarantee. I say, why? And they say, oh, well, you know, what happens if things go wrong? Are you planning for things to go wrong? You know, take out some insurance, mate.
Yeah.
That's how that's how it works.
Right.
You know.
Yeah.
And that can also be extremely tax efficient if you get it right as well.
Yeah, for sure.
So there's no way of getting every single thing that you want.
Right.
Because if there was, this would be so easy. And like we were saying in another video, it would be everyone would be doing it. There'd be no bin men. There'd be no people working at Sainsbury's because everyone would be a property investor.
Exactly.
Yeah.
So it's really, really hard. There's loads of tricks of the trade, and you've got to learn those by surrounding yourself with people that like yourselves that have done it, or people like myself or other people that can advise you on certain things, to make sure you make as few mistakes as possible and get things right.
Yeah, absolutely.
I mean, you sort of answered the next question in that one. Is it necessarily harder or easier to get a mortgage in a limited company over a personal name? But you've kind of
it's not really that different. You don't actually necessarily need to do that now if you are switching. Yeah, lenders now are so sophisticated when it comes to lending to limited companies. Realistically, the big difference is just the personal guarantee that you have to pay for, and you know, pay someone the privilege of sitting with you for 40 minutes to read through a document.
Gosh.
It's amazing.
ridiculous.
Yeah, it's amazing. I'm like, do you understand this language though?
Yeah, they do. They're always solicitors. They understand everything.
We use a specialist legal firm that only deals in
normal human language.
It won't normal human language, but no, just independent legal advice.
Oh, okay.
So yeah, so we just send them to them for that, and then they've got their existing solicitor for the other stuff.
Yeah, that's good.
But yeah, I think really the only difference is usually the rate. You know, rates are cheaper in personal name because generally you can go to, you know, your standard high street lenders who will lend on buy-to-lets in personal name, but the reality is your Santanders and your Barclays are not set up to do buy-to-let mortgages. So if you start buying more than 4 and you become a portfolio landlord, very, very quickly the high street is not going to lend to you anyway.
Yeah.
So you're going to have to start using the specialist lenders that they might have a small difference in price between personally owned and limited company, but it's going to be a lot less. So the reality is you sort of lose that sort of incentive, if you like, quite quickly.
So if I'm a new property investor, should I be setting up a limited company to be purchasing property right now? Is that what I need to be doing?
I can't give tax advice because I'm not qualified.
Oh yeah, of course, yeah.
But we can talk about certain facts, and that is that if you are going to be building a large portfolio, is it better to start as you mean to go on? I think for a lot of people, maybe it is, because actually any savings you make short term are going to maybe sort of be undone as you get to the point where you are a higher rate taxpayer. You know, imagine these rents are going up. So you've got 4 properties, and you're earning however much you are every month off of them, and that gets to a point where you actually become a higher rate taxpayer. You could actually start technically making a loss because you can't offset the interest, as we said before, and you're paying your tax on the whole of the amount you're paying. If you're suddenly having to pay 50% on anything above 50,000, then actually that's just going to cut straight into your profits, and you might end up just actually not making any money out of it. So it depends on everyone's personal circumstances, what your personal income situation is, but for a lot of people, it's definitely worth speaking to a property tax advisor, someone that specialises in that, and just getting the right advice, because it's going to be down to your personal circumstances and figuring that out. But as I say, I talk to my clients a lot about, sort of start as you mean to go on, and having these structures set up a lot of the time tends to make a lot of sense, because I just believe you get, as someone that runs their own company now, I see the benefits of that, because you have the freedom to choose how you pay yourself and how you pay your tax, and so you can, manipulate's not the right word, but you can be as efficient as you possibly can with that, which I think just makes you a better business person.
Yeah, for sure.
Yeah,
for sure.
nice. Yeah, and actually, I think when we first set up our company, that's kind of how we looked at it. We wanted it to be that long-term vision, that long-term thing, so we went about it like that.
Definitely. Final question. How much deposit do I need to put down for a UK investment property in 2023?
If we're talking about mortgages, you can get a 80% loan to value mortgage, which would mean a 20% deposit. The difference in interest rate that you're going to be paying between 75 and 80% on a buy to let is probably going to be quite a lot. And as I said, with rents at the moment, it's probably going to be quite difficult to get to 8% regardless. So the standard is 25%, standard is 25%, 75%, and also you don't really want to go above 75%, because as you become portfolio landlord, which means that you own 4 or more properties, lenders will do a background stress test on your whole portfolio, not just the property that you're buying, your security property. And if you're leveraged over 75%, generally speaking, that means that you're more likely to fail that assessment.
It might be hard to get future lending if you've got more than 75% lending on all of your other 4 properties. You get to the 5th.
So only do it if it's absolutely necessary. Now, obviously, we've spoken about other ways of financing properties. If you're using bridging finance or development finance or something like that, let's concentrate mainly on bridging, just to make it a little bit more simpler. So we're still governed by the same sort of loan to value limitations, so let's say 75%. However, it's how you pay the interest that will change the deposit that you're actually going to pay on something like that, because that 75%, we call that the gross loan. And what that means is that the interest and fees that you're going to be paying is incorporated into that 75%. So when we deduct those, what remains, our net loan, is actually what's going to contribute to the purchase. The difference between that and the purchase price is going to be what we need to put down as a deposit. So typically speaking, if your gross loan is 75%, your net loan might be 70%. So you need a 30% deposit rather than a 25%. We can do something called serviced interest, which is just like a normal mortgage, paying the interest on a monthly basis, but you will have to personally show that you can actually afford to pay that interest, because it's not down to the rental income that you're going to be generating, because you're not generating any yet, and the lender knows that. So that becomes a bit more complicated. So bridging is a little bit different. On the whole, 25% for a mortgage. If we're doing anything a little bit more creative, a conversion, BRR, that kind of stuff, then we're going to need a bit more than that.
Just one more question I quickly have on bridging loans and the interest. Do you tend to always see that the interest is deducted up front and then reimbursed at the end of the loan? Or is there any bridging loans where you actually pay it, so whatever it is, every month?
It's down to the client, to be quite honest with you, how much funds they have available, how they want to go about doing it. Some clients will say, well, actually, I don't want to put down that much money. I'd rather hold some back. If I have to pay it monthly, happy days, but I'd rather hold that money back in case someone else comes along. I can reallocate those funds into there. Not all lenders will do it either. The default setting, if you like, for lenders is what we call retained interest, which is where that interest is deducted at source. Now, one of the things I get a lot is, well, if we have a 12-month term, so we're deducting 12 months worth of interest, what if we pay it back in 6 months? Well, most lenders, they won't have any early repayment charges, which is great. And when you get your redemption figure, it will only include 6 months worth of interest rather than that full 12 months. So as much as it's annoying at the start, because you've had to put down a bit more, you won't have to pay back as much as what was originally quoted. So you only pay for what you use, which is actually amazing.
Yeah.
Because it really does. I mean, I've got clients who do HMO conversions in 3 months, so they're only paying 3 months worth of interest. And if you work that out, so imagine you've got you're borrowing money from an investor on a fixed rate of return of 10%.
Yeah.
But you're on a 1% per month plus a 2% fee with a lender. You're actually only paying them 5% to use that money.
Yeah, it's really smart, especially if you can get your HMOs or whatever. The best one we ever did was 3 months in and out.
Yeah,
But,
and it obviously gives the lender the security that they put the funds up front.
Yeah.
And it gives us the flex to.
Well, do you know what it is? It's because they have to do that affordability assessment.
Yeah.
And believe it or not, there will be something written in one of their files to say they've done it. But if they've retained the interest, then your monthly payment's zero. So I haven't come across anyone yet that can't pay £0 a month in a payment, so they can just tick a box.
Yes, for sure. Well, that was super interesting.
It really was.
So good. Thank you so much for answering some of our FAQs that we get sometimes, and actually some of our own questions.
That's fine.
Where can people find you online?
So I'm very active on Instagram at the Sam Norris. I post a lot on my YouTube channel, which if you just type in Sam Norris, the property investors broker, you will find me. In fact, I think if you just type in Sam Norris, you'll find me. And I also have my own podcast, the Game of Loans podcast, which comes out between once and 3 times a week, depending on how active I am and how much time I have on my hands. And that's, we're up to about 114 episodes of that now.
Wow.
That is fantastic.
That's amazing.
I will link all of that in the description box. So if you want to go and check out Sam's channels, podcasts, Instagram, TikTok, everything, you can go and click on those links. Thank you so much. It's been really, really fun.
Yeah, it's been so fun. I've learned so much. I just want to keep going.
We could talk all day, but hopefully we'll see you on your podcast soon.
Yeah,
that'd be awesome.
Yeah.
And thank you guys for watching. Don't forget to subscribe if you're not already subscribed to all of our channels, and we'll see you in the next one. Bye.